The next segment we're going to talk about today is the Fort Pitt Capital Group strategies and tactics. Again, for anybody tuning in the first time, I have Charlie Smith and Dan I here with me. They are the head of our analysis team. And Dan, we're going to start this session out with you. Has the firm ever contemplated moving a notable portion of the client cash portfolios, and why or why not?
Okay, so first I'd say, that we firmly recognize that, this volatility and market declines are extremely, uncomfortable, and it would be much more, comfortable to raise a bunch of cash, preferably, before the market decline, wait on the sidelines until, all the bad stuff passes us by, and then start to invest again. Unfortunately, that's not how markets work. And the one point that I've been stressing with clients on calls is that, markets don't wait. They don't wait for all the negative headlines to stop, or for the economy to stop getting worse and start getting better. Markets are forward-looking animals. They price in the risks, the uncertainties, the potential negative outcomes. They often, overshoot to the downside, and then they move on. And when markets transition to that move on phase, it's often a violent move to the upside. So, while it does sound great to try to sidestep the volatility, in reality, what that usually translates into is investors selling stocks after a massive decline, and then buying back in at much higher levels. At least that's what I've seen throughout my career. And I think history really shows us how difficult, or maybe more appropriately impossible, it is for investors to truly sidestep those periods of volatility. If we look back over the last 40 years of stock market returns, we've seen 30 of those years be positive. So very solid batting average for equity market returns. But there have been 8 periods throughout those 40 years where we've seen declines of 20% or more. And in fact, if we were just to take a simple average of the intra-year declines across those 40 years, it's about 14%. So we just think, a much more appropriate approach is to, adhere to a very well thought out investment plan and strategy. And that's a strategy that needs to be, followed in the great times like 2019, when the stock market's up 30+%. And in the periods of stress, like we're dealing with in the current environment. So, deviations from that plan can certainly derail that well-crafted long-term investment plan. And I think history tells us that there's going to be plenty of opportunities for those deviations.
With that in mind, we hear a lot of the clients talking about the assumption that the market's probably going to continue to go down before it gets better. And the question becomes, should we raise some cash and buy stocks when they're lower?
Yeah, so I just gave kind of a long-winded answer to a similar question. So I'll keep this one a bit shorter. But yeah, I mean, that's a perfectly logical strategy if you knew, markets were going lower. Problem is, no one knows what the market's going to do over the short term. And I think, investors would probably be very comfortable with that outcome of assuming that markets are going to go lower on, let's say, March 23rd, when we hit at least what we'll call an intermediate bottom in the market. And then we've seen a 19 or 20%, rally to the upside, as Charlie mentioned, over the last several weeks. So we just don't think this is an environment that investors are going to be able to time. And not like there are any investor environments when that's easy, but we think a much better approach is, to be patient and be willing to buy great businesses, at great prices when the market presents you with such an opportunity. And we think that that's the right approach over time. And just maybe one final point is that, investors should be remembering, their time horizon, and those time horizons are not measured in weeks or months or quarters, for the vast majority of our clients, their time horizons are managed or measured in decades. So I think that's a really important point too.
Great. Charlie, I'd like to bring you in. What steps have been taken to potentially protect clients' portfolios and assets and long-term financial planning goals? And along those same lines, what are the plans for the weeks and months to come?
Great. Yeah, and this question sort of piggybacks on what Dan was just talking about. The implication in the question is that we can somehow change our tactics today in the midst of the crisis and somehow protect clients. And, the most important protective steps have already been taken, and they come in the form of a financial plan and an asset allocation that allows you to sleep at night and avoid worrying about where your future cash flows are going to come from. So essentially, the plan for the weeks and the months ahead is really no different than the plan that we had for the last 6 months or the last 6 years, most importantly. Recognize that the stock market, as Dan just laid out, goes haywire about twice every decade. I mean, really haywire, down 40, 50%. And your plan is designed to weather those periods. And frankly, I would define periods like this as high risk because they create the tremendous risk that clients are going to try to do something to upset this well-crafted plan. And they're going to do something that is sell out of fear and really wreck years and years of success in one brief moment. And that would really be unfortunate. So our job really, and where we earn our living, is helping clients through periods like this, telling them and showing them that they've got a well-crafted plan that's built for periods exactly like this, and they will get through it just fine.
Stay the course, right?
Right.
Dan, let's go to you. What are you doing to take advantage of the market? Are you buying anything?
Yeah, I like that question a little better. So, we did start to do some buying in the middle of March, a period where we felt that really the fear and panic that we were seeing translated into, a disconnect between a lot of stocks prices and their underlying, long-term fundamentals. So I would describe our buying as maybe some nibbling and measured and patient, but going forward, don't have a plan to chase market rallies, but we do have a list. We do have a plan. We have a number of great companies that we want to own over the long term, and if we do see a situation where those, again, prices disconnect from fundamentals, we don't expect it to feel comfortable, but we think taking a view of doing some buying is the right path for the long term.
Great. What about strategies or tactics that you might be employing on the fixed income side?
So first, I'd say that the process or our focus really hasn't changed a great deal. The process has already been in place, but we're in fixed income portfolios maintaining a short duration stance, meaning we're not buying long maturity bonds. We have the backdrop of historically low interest rates. We don't think that is a good environment to be taking on the type of interest rate risk that's associated with those long maturity bonds. And again, the core of our fixed income portfolios, investment grade corporates and high quality municipal bonds, none of that's changed. We continue to work through the credit analysis process when we buy bonds. We're continuing to apply that same process to the bonds that we already hold. And as always, looking at the risk to return trade-off of our holdings. We have, nothing very broad, but we have sold, a few bonds recently, and not situations where we saw necessarily, defaults or bankruptcies as the most likely outcome. But, we've also recognized that the risk has increased in a number of areas and sectors. And we have made some changes, to areas where we see less stress going forward.
Great. So are we thinking of selling underperforming stocks and buying ones that may recover faster? Charlie, what's your take on that?
Yes. The periods like this are always an opportunity to upgrade the quality of your portfolio as value managers, we sort of always maintain a wish list of businesses that we think are good businesses, good companies, but they typically don't sell at a price which gives us a chance to buy them, which makes them a good investment for us. So we're always sort of watching and waiting for periods like this where we can get companies that we like at better prices, and we've done some of that. We've also looking to sell some of the names which have underperformed, and also we're actually selling some of the names that have actually held up better in this decline, so that we'll have a little more cash to buy some of the names we like that have declined more. So it's always a continuous process of pruning and trying to upgrade the quality of the portfolio, and making sure that the names that are on our wish list, if they get into the buying range, we take advantage of that.